Hey everybody, hope you're all well. Welcome back to another Learn to Trade video. Now in this one, I just wanted to go over how to actually and properly identify supply and demand zones. Now this is a key thing because obviously when we do our analysis, when we do our top down and intraday analysis, we are basing our trades off the analysis and most importantly off our points of interest. So points of interest for me, that is supply and demand. For other people who trade like Luke, technical traders who are potentially looking for Fibonacci boxes, support and resistance, obviously the same rule applies. I won't be covering those tools, but the same rule applies within you need to determine how to identify these correctly, because we are identifying where we want. We're not identifying it correctly. We're shooting ourselves in the foot because all of the trades we place are then going to be corrupted because they're using the foresight that we've gained from those points of interest, and if we've identified them wrong, chances are the win rate we gain when we come to place those trades is going to be much less. So for me, a smart money trader, the one thing I always say in order to identify a supply or a demand zone is either the last buy before sell or the last sell before buy. That is a very basic concept on how to identify these and also how to draw them out. So if we just use a brush tool here to give an example, price is bearish, it's trading down, and then all of a sudden we see some momentum injected into the market. Clearly supply is very dominant at this point because we've just had a heavy shoot down. We have some market inefficiency. Now, what a lot of people here are going to think, let's say price plays out like this. Now, people are going to think, okay, this should be a protected high. We don't want to see this get penetrated. Now, yes, if we're going to follow fractal structure, this should be a protected high. However, in this region, we do still have a last buy to sell. But on top of that, we also have all of this market inefficiency. Now, if we were to go down time frames, we'd be able to see that there are very minimal amounts of retracements. Now, what this means is that within every single fractal retracement that isn't visible on a higher time frame, we have had smart money control, we've had some institutional control where they have had to execute positions. When we have an inefficient market, that means that the smart money operators aren't being allowed, or at least when we're bearish, I should make that disclaimer, the smart money operators aren't being allowed to reverse the market back up to mitigate positions before going lower. So within an inefficient market, so within this entire region, we know that price probably wants to come back to this region because there's so many unmitigated positions. On top of that, we know that the last buy to sell in this region is also unmitigated. So we're basically getting a 2-for-1, which is why we should always look to pair a supply or a demand zone with market inefficiency. So for a supply zone, we look for some market inefficiency below. With a demand zone, we look for some market inefficiency above. So that's just a base concept in a practical standpoint or a theory standpoint, sorry. Let's now just go onto the market and I will show you exactly how I'm looking to identify points of interest and why I believe they're valid. So looking at the pound to the Japanese yen on the monthly time frame, let's start from the swing low. We trade up to a swing high. We then trade down. We have another swing low. After price displaces, we know that this is the lower market. We also know that that low is higher than the previous low. We then come to create this swing high. Now, when we penetrate this high and when we put in a higher high in the market, A, we know that we are now following bearish structure, but B, we also know that this should be a protected low moving forward. This would be our range. So our final target here, our invalidation point here. And of course, we would have been looking inside of this region for demand zones to actually buy from. However, price blows through. We blow through a protected low, and the second we blow through that, we then take the entire wave that caused that. So this entire wave as an impulsive wave downwards. This is the very first impulsive wave of this monthly bearish structure that has emerged. So using the 3-box strategy, if you haven't watched that video already, check through the channel. I have run through exactly how to do that and what it represents. Regardless, looking inside of here, like I was speaking about, we have a lot, I mean a lot of inefficiency. So I gave a pretty good example where we have some bearish structure. We have a heavy buy to sell and then an inefficient market here. So if I was to pretty much represent what I was showing you, we have this heavy buy to sell here, a large move down, a push up, and then price seems to continue. Now, most people are going to think this or this point is what it represents here. Should be a protected high, we shouldn't penetrate it. What should actually happen is we should trade back up somewhere within this impulsive wave, hold the high, find a supply zone, make a new leg lower. However, we have decided we no longer want to follow fractal structure. We're now actually putting in place a retracement in the larger scheme of things. So what that means is we're going to run this liquidity high. So run the liquidity that is left over from people who, as I was saying, were looking for sells somewhere within this impulsive wave. But then secondly, as we were stating, there are so many inefficiencies in this region, positions that have not been mitigated and price needs to come back to in order to mitigate them. So we can pair this buy to sell, which yes, it could be refined, but as of right now, we know that that entire region there is a buy to sell. And then we've also paired that with an inefficiency below, because it's a very inefficient price action. We know there's going to be a lot of positions in here that haven't been mitigated. So is another excuse for price to want to trade back up to this region. And obviously hindsight's a wonderful thing. We've seen that price has played out the way we wanted it to. Price has traded back up. It has tapped into this last buy before sell. It has filled in some of the market inefficiencies, and then it has displaced. Now what I mean by that is that if we were to view this retracement as bullish structure, you will see that if we get the paint tool, we've had this structure inside, and then as we've gone to break this high, this low right here should have been protected. The second that price blows through, we know that we are now displacing the bullish structure. We are now going bearish. So after this happens, we know that we've had a reversal inside the point of interest, or from the tap of the point of interest, and then we've moved lower. Now moving forward, we would take this as an impulsive wave again, as the blue box. And one thing just to actually highlight, making sure we are following the 3-box strategy. Obviously this place here, including the displacement, that would be our Wyckoff, that's our distribution, that is our entry confirmation. Not something we're focusing too much on now. However, if we look in this wave again, where would you ideally want to find a point of interest? So following the laws that we were saying, is there anywhere where we have a heavy buy to sell paired with a market inefficiency? So to me, we have a buy to sell here. So this region would have represented a supply zone to me. Point of interest. So we have a point of interest there. Obviously, we have some market inefficiency within this point to this wick. Now, once we saw price reverse, we could have made the assumption that yes, price is going to want to come back up, trade bullish, fill in any market inefficiencies and tap the zone. Now it's done that perfectly. We do see the tap, although we now know that price has disregarded that. The great thing is we could have entered a position here. Obviously we would have had our final take profit all the way down here, which would have hit. Now even though price wasn't fully ready to make a big move lower from this zone, we still could have got involved, taken partials along the way, and we would have more than likely had a take profit at this region, so a take profit would have been hit. Now moving forward, obviously we know that price has disregarded this zone, price has actually traded through, so we need to then look higher up in the zone and say, right, where else do we want to see mitigated? So to me, although this is the final buy before sell, what's happened is that this retracement has come back up and it's filled in some of that candle that we would have highlighted. So let's say I wanted to identify the last buy to sell as a point of interest. You can see inside of that, we've already tapped into it. It's already been mitigated. We've already missed the opportunity to get in on a sell there. So we look again. Okay, well, this candle right here is a buy to sell. We've pushed the market up, reversed lower, and then straight after that, if we just highlight it quickly, straight after the buy to sell, we can see once again we have market inefficiency. Right here, this entire candle is inefficient. We come down here, and the only place we have a real retracement, evident by the wick, is we've had the straight drop, and we've had a retracement back up to here. So everywhere between that line there to the point of interest is an inefficient market. So we want price to come all the way back up, fill in the inefficiency that's been left in this region, tap and mitigate the zone, and then potentially make a move lower. So that is a great way on validating or finding the correct supply and demand zones. Obviously, we've just been using supply zones as an example. However, Obviously, it is the flip side when it comes to demand. We're looking for inefficiencies just above. But that right here, yes, we could have identified or tried to identify supply zones in many different ways in this region. However, the two valid ones to me are the two we have drawn out, because we've got a buy to sell, and then straight afterwards we've got an inefficient market. Now, if we go into a bit more depth onto why this happens, it's because when we've had this buy to sell, that is institutional control. So when we have a correct supply zone drawn out, so a buy before sell, what's happening in the market is that the institutions are executing large buy positions to manipulate the market, and then once they've done that, all upside target has been done. They've manipulated the upside. Now they are free to execute shorts in this direction. So if we actually just highlight this zone and we'll replay it back, it's going to be very likely, not guaranteed, but very likely that price is going to show us something that I think it will. So if we replay back to this point, and let's just go down to a daily, look inside of the box that we had highlighted. Yep, right in here. So this is obviously our point of interest. Now what we see is that we have a lot of liquidity built up within this region. We can see that there is a lot, especially next to the actual buy before sell. You see all of these wicks is representing that price is being rejected from this region. So any technical traders are seeing this as a resistance level and are looking to execute shorts from this region. So if we just draw out every single high that we have in this region, there are so many times that price has tapped in and reversed, but then eventually we see there's a heavy move starting from this point all the way up that comes to clear all of that liquidity. So if we just mark out the very top, you'll see that it pushes through every single high that was created. So this is another great example of inducement and momentum. We've created a level of inducement. We have induced early sellers into the market, built up liquidity. We've then executed a large buy position. So we could try and refine the zone to the position that was executed, which would be this right here. We'll get rid of this. So that is the exact zone or the exact area where they have executed the buy position that caused the break of structure, that caused the liquidity sweep, that caused the manipulation. So this is an institutional candle right here. And straight after this, as I said, what's happened is once they have done all the upside objectives and once they've cleared that liquidity, they now have the highest possible price that they can get for sell positions. So they're going to open a very, very large sell position, which is why we then have an inefficient market, because they've executed a large position, which has brought so much supply into the market that price has just pummeled lower. So if we now go off this, obviously you can see that we have refined that, but that was the zone that we were looking at. That was the region we just looked at, and that is how we can confirm if a supply or demand zone is valid. We can go down the time frames, look inside and say what actually happened in this region. Is it really an institutional candle? Now we went down, we saw inducement and momentum, which is a clear indication of institutional control. We found where they were present, we've identified that, and now we are waiting to see if price taps into it, mitigates that position before reversing lower. So that is just a quick lesson on correctly identifying supply and demand. If you have any questions, make sure to leave them in the comments. This is a topic I will definitely cover in further detail within a webinar to maybe the VIP clients or in the Learning Lounge. So if you're not involved in either of those, make sure you either A, get involved in a Learning Lounge, which is completely free, or if you want to take your trading to the next level, we do have the VIP chat available. I'm not going to ramble too much on about that. If you're interested, just check our website. With that being said, thank you for watching, and I will see you in the next video.